Good day, everyone. Welcome to our video recorded lessons in Fundamentals of Accountancy Business and Management 1. Today, we are going to discuss on Module 5, which is on the 5 major accounts. But before we proceed to our discussion, let me present to you our learning competencies. Number 1, discuss the 5 major accounts. And number 2, prepare a chart of accounts. Now that you were able to identify the balances of the 3 major accounts of Juan P. Rodriguez computer business, and you were able to help him in answering his problem in deriving his rate income for the first month of operations, let us acquaint ourselves to have an in-depth discussion of the 5 major accounts under the Statements of Financial Position and Statement of Financial Performance. So what are then our 5 major accounts? To start with, let's discuss our first major account, which is asset. Assets are what the company owns. As defined, assets are the resources controlled by the entity as a result of past transactions or events and from which future economic benefits are expected to flow to the entity. These are the properties of the business expected to be utilized for its benefits. It may be tangible, meaning to say, with physical properties such as land, building, furniture, and fixtures and the like. When you say tangible, meaning to say it can be touched, right? Let's say table. It is a tangible asset because it can be touched. However, there are also assets which are intangible by nature, meaning to say they do not have physical properties such as trademarks, copyright, patent, and the like. So you cannot touch the copyright of the book because by nature it is non-touchable, or meaning to say it is intangible. Now, there are 2 classifications of assets. Number 1, we have current, and number 2, we have non-current. When can we say that an asset is current? Current assets are those reasonably expected to be converted into cash within 1 year from the date of report or the normal operating cycle, whichever is longer. Operating cycle is the average time period required for a business to make an initial outlay of cash to produce goods, sell the goods, and receive cash as payment for the produced goods. If it does not meet the definition of current asset, or if such assets are realized for more than a year, it is classified as non-current assets. So what are then the examples of assets? Number 1, we have cash and cash equivalents. In the accounting parlance, the term cash has a broader meaning. In layman's term or in our day-to-day living, we usually refer cash as those which are in the form of currencies or bill. So like a 1 peso coin or our 20 peso bill, we usually refer this as money. But in accounting, there is a broad meaning to cash and cash equivalents. It entails more than money. It includes money and any other negotiable instrument that is payable in money and acceptable by the bank for deposit and immediate credit. Now, it includes cash on hand. So cash on hand refers to these bills and coins, checks, money orders, and etc. So these are the cash which are being possessed by the owner of the business or which are in the hands of the business owner. And there are also cash which are in bank. So example, savings account, checking account, time deposit, and etc. So these are cash which are not in our hands but in our bank accounts under the account of the business owner. And cash funds set aside for current purposes. So example, we have our tax or our payroll to be paid to our employees. So we are usually set funds for these expenses. On the other hand, cash equivalents as defined by Philippine Accounting Standard 7 Paragraph 6 are short-term and highly liquid investments that are readily convertible into cash and so near their maturity that they present insignificant risk of changes in value because of changes in interest rates. Stated further, only highly liquid investments that are acquired 3 months before maturity can qualify as cash equivalents. Example, 3-month treasury bills, 3-month time deposit, etc. So, this will be further discussed in our next modules in the Fundamentals of Accountancy, Business and Management. But for now, let's settle first on the basic definition of cash equivalents are. To proceed, we have the number 2, or we have another example of assets. We have accounts receivable. So these are open accounts or those not supported by promissory notes. This is a result of businesses selling goods or services not paid in cash on account. So one example for this is that you are the business owner and you have a client or a customer. And then he wanted to buy the product, however, he does not have a cash. So instead, he wanted to buy it on credit. So say for example, if we're on April 20 today and he wanted to settle it on April 30, then on April 20, you recognize accounts receivable because you have not received cash. Instead, you will be able to collect the cash come April 30, whenever the customer or the client would be able to pay. Next, number 3, we have notes receivable. Notes receivable, on the other hand, these are those supported by formal promises to pay through promissory note. Now, in accounts receivable, usually there are no promissory notes because these are usually charged on account. However, for notes receivable, these are evidenced by promissory notes. The same concept is being applied with accounts receivable. However, this or for this type of asset, these are evidenced by promissory notes. Promissory notes are written notes signed by the debtor of his promise to pay a certain sum of money on demand at a specified date in the future. So we need to say he has to sign agreeing that he has to pay the certain sum of money at a specified date in the future. Say, for example, in our example previously, he has to pay it on April 30, but however, he needs to sign a promissory note in order for it to be considered as a notes receivable. Number 4, we have inventories. What are inventories? Philippine Accounting Standards number 2 or paragraph 6 defines inventories as assets which are held for sale in the ordinary course of business, in the process of production, for such sale, or in the form of materials or supplies to be consumed in the production process or in the rendering of services. So what are inventories? Usually these are actually the merchandise that are being sold in our stores or in our businesses, or if we are in the industry of selling lots or lands, then our inventories are our lots. If you are in the business of real estate, such as we are selling house or Camellia perhaps or Aldea homes, so we are actually selling. Aside from lot, we are also selling our houses. So our houses and our lots in the real estate business are the inventories. If we are in the business of selling cakes, then our cakes are our inventories. Okay. Next, we have unused supplies. Unused supplies, this represent the portion of supplies acquired but not used at the end of the accounting period. Example, you purchased 10 reams of bond paper on November 30, 2020. And then here comes by December 31 of 2020 because we will have to close the books. Now there are 4 reams of bond paper which are not used. So these 4 reams of bond paper are considered as assets because at the end of the accounting period, we have not yet consumed the supplies. For those 6 consumed supplies, these are already considered as expenses. But for those bond paper which have remained unused are considered as our assets. Number 6, prepayment. So from the word itself, we do payments in advance before we consume the asset. So these are assets paid in advance made to cover future consumption like prepaid rent, prepaid load, and etc. So like a prepaid load, if we purchase 100 peso today, it will only be consumed whenever we have to do text or messages. So say for example, if we purchase 100 today and you were able to make 2 messages or 2 text messages at the end of this day, then ideally our prepaid load would be 98 pesos at the end of the day because we have consumed 2 text messages which are equivalent to 1 peso per text message. Since there are 2 text messages in the day, so at the end of the day, our balance would be 98 pesos, right? Okay, so the 2 pesos has been consumed already. However, the 98 pesos at the end of the day would still be considered as prepaid load. And then next day, if we consume again text messages or whenever we make calls, and then at that time our balances would be updated. So those balances which have been consumed are already considered expenses. However, for those balance which are still unconsumed or which have not been consumed are considered still as prepayments. Okay, let's proceed to number 7. Property, plant, and equipment. Philippine Accounting Standard 16 defines PPEs as tangible assets which are held by an entity for use in production or supply of goods and services, for rental to others, or for administrative purposes and are expected to be used during more than one period. Since these are tangible assets, PPEs have physical substance, meaning to say it can be touched. Now, PPEs are expected to be used in businesses for more than a year, meaning used in production of goods or supplies, for rental purposes or for administrative functions. However, those which are held for sale or held for investments are not included in PPEs and thus labeled as current assets. So example of PPEs, we have land, and then we also have building. So land refers to the physical site owned by the business where the building is erected. It is not subject to depreciation. Okay? Because land, although it is an asset, but it does not depreciate over time. Building refers to the physical structure used by the business in its operation. Now, if you are solely using this for your business as your office, as your store, these are considered or these are labeled as property, plant, and equipment. However, if your business is engaging in real estate, such as selling lands or selling buildings, then these are considered as your inventories. Okay? So be careful with your classification. Be careful with the definition, because not at all times that a land is always a property, plant, and equipment. It may sometimes be an inventory. Same goes with your building. Okay? Now, equipment refers to the manual and automated machines such as computers, vehicles, and etc. used by the business in its operation. While furniture and fixtures refers to those fixed assets owned by the businesses such as sofa, tables, chairs, and etc. or like cabinets or any furniture or fixtures that you actually possess or you actually own as the business owner. Okay, so let's proceed. Next, we have allowance of doubtful accounts. Allowance of doubtful accounts, this is a contra asset account wherein it refers to the portion or estimate of the accounts receivable that is estimated to be uncollectible at the end of the accounting period. When you talk about allowance of doubtful accounts, this is the portion, say for instance, accounts receivable. If the person or the customer owed you, let's say 100,000, he actually promised to pay at the end of the month for that certain sum of money covered. And then you actually are trying to project, because with the pandemic, the customer's business also got into bankruptcy and got closed. So you're actually expecting that not all or not the whole amount of 100,000 would be collected from the customers. That's why we have to set an account which is allowance of doubtful accounts, meaning to say we are actually apportioning a certain percentage. Let's say, oh, his business is into bankruptcy. I don't think I would be able to collect the 100% of 100,000. So I'm actually trying to provision or actually trying to make an estimate of 30%, which I believe or I am in doubt that I would be able to collect that 30%. So I would only be expecting around 70%. Okay? So that 30% is actually a provision for allowance of doubtful accounts, because you are trying to project as a business owner that this certain sum of money would not be able to be collected due to varied reasons. Example, bankruptcy, or like if there are presence of calamities and the customer or client wouldn't be able to pay you on time or would not be able to pay you the whole amount of time. So that portion is actually provided so that we would be actually anticipating or projecting as to the amount of cash that is being or that we expect to flow in our business. For number 8, we have accumulated depreciation. This is a contra asset account wherein it refers to the aggregate portion of the total cost of property, plant, and equipment that has been charged to depreciation expense. Accumulated depreciation, so for instance, our building. If we believe that our building is its life is up to 30 years and its value is 1 million, then we have to divide 1 million by 30 years. So what would be the resulting factor? 1 million divided by 30 years, that is around 33,000 pesos. So every year, our depreciation expense is 33,000. So accumulated depreciation, you will have to count the number of periods, you have to count the number of periods added to the previous depreciation from the previous year. So at year 1, our depreciation expense is 33,000, and then our accumulated depreciation at the same time is 33,000 because in year 0, there is no depreciation expense, right? Now in year 2, our depreciation expense will still be 33,000. However, our accumulated depreciation now becomes 66,000 because the depreciation has accumulated from year 1 to year 2. That is 33 plus 33,000 again for the year 2. But for year 3, our accumulated depreciation now becomes 99,000 because that would be 33 from year 1 added to 33 from year 2 and added again with another 33 in year 3. So the 99,000 is the accumulated depreciation. However, the depreciation expense remains to be at 33,000 pesos. Okay? So those are actually our examples of our asset accounts. So we have 9 asset accounts. Now let's go to our next major account, which is our liabilities. What are then liabilities? Liabilities are what the company owes. If our assets are what the company owns, liabilities are what the company owes. Or what are our liabilities? To whom do we owe? Or how much do we owe to someone? Okay, these are considered as liability, or in Tagalog or Filipino, it's utang. Okay? As defined, liabilities are present obligations of the entity arising from past transactions or events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. These are the payables of the company to various creditors, suppliers, and other resource providers. So if you are the business owners, usually we are the debtors and the creditors are our suppliers. Our creditors or lending institutions or banks, financial institutions, or our resource providers. This is the time that we become debtors, okay? And our creditors are our various creditors such as suppliers, our banks, or financial institutions. Liabilities can be classified into two. We have current and non-current. Current liabilities are those reasonably expected to be settled by payment of cash, delivery of goods, or performance of service within 1 year from the date of report or normal operating cycle, whichever is longer. Okay, same with cash. Those realized within 1 year are considered as current. For liabilities, those which are reasonably expected to be settled by payment of cash within 1 year, then this is considered liability. Else, if it does not fit the definition of current, or if it's realized by more than 1 year, then that will be considered as non-current. So we have examples of liabilities. Number 1, accounts payable. Accounts payable, this is open accounts which represent the amount owed to creditors. So same with accounts receivable, these are not evidenced by promissory notes, but instead, these are actually accounts which are being set up under our names, and these are actually open accounts. Okay? So for notes payable, these are evidenced by promissory notes. Loans payable, these represent the amount of money borrowed from external creditors such as bank and other financial institutions. So if we would like to borrow a certain sum of amount from the bank, that's considered as loans payable already because we actually owe a certain sum of money to the bank. Mortgage payable, this represents the amount of money from external creditors such as banks and other financial institutions, evidenced by a security in a form of collateral. So if you would like to make a loan from the bank and the bank requires a collateral, say for example, our title of the lot or the land or our building or our vehicles, then that is actually defined under mortgage payable. We need to say we are actually, or our liabilities are evidenced by security in a form of collateral. So they need collateral, but for loans payable, there is no need for collateral. In mortgage payable, these are actually these type of payables are evidenced by securities in a form of collateral. Okay, like for lot title, or usually when you make a loan from the bank and it requires a lot title of the land, then you will have to surrender your original, then to be annotated. Annotated meaning to say there is something, there's a written note at the back portion of your title of their land that this has been encumbered or this has been loaned to a certain financial institution. Okay? And lastly, we have unearned revenues. Unearned revenues, cash received as payment in advance for goods and services to be delivered or rendered at a future time period. When we talk about prepaid assets or prepayments, these are actually paid in advance. However, we have not consumed the service or the goods. For unearned revenues, we already have received the cash. However, we have not yet rendered the service or we have not yet delivered the goods. Say, for example, if we are actually engaging in a business of laundry, okay, and then you actually or the client actually paid you 1,000 pesos for the whole month for the payment of the laundry, and then you have not yet done the laundry. So meaning to say, instead you owe 1,000 pesos to your customers. Why? Because you have not yet rendered the service. Meaning to say, you already received the money, however, you were not able to render the service yet. Same applies with goods. Example, if our customer of our client has paid 10,000 pesos and you have not yet delivered the goods, we need to say they were not still able to receive the goods, then that becomes a liability on our part. We need to say we have not yet earned revenues for that because we have not yet delivered the goods to our customers. Okay? So that's it for liabilities. Now let's go to our third account. Our third major account is equity. Equity is the residue after exhausting all liabilities from assets. We need to say assets minus liabilities is equal to our equity. As defined, equity is a residual interest in the assets of the entity after deducting all of its liabilities. It can be increased by investments, whether initial or additional, and income, and can be decreased by withdrawals and expenses. Okay? So, to explain further, this part or this account can be increased by investments. Okay, if you add investments or you initially put up an investment, then that actually increases your equity. However, this can also be decreased through withdrawals and expenses because this account, which we will further discuss in Module 5, is actually your residue account. Meaning to say, your temporary accounts will be closed to your statement of financial position through our equity account. So we'll discuss that further in the next module. Okay? Owner's capital use is classified under equity. In corporation, shareholders' equity is the residual interest of owners in the net assets of a corporation measured by the excess of assets over liabilities. So simply stating, in proprietorship or sole proprietorship and partnership, we use the capital account under equity. But for corporations, we use share capitals. Okay? For corporations, share capital is divided into two classes. The first class is ordinary share, and the second class is preference share, which will also be further discussed in the next chapters. Income is shared through dividends. So in corporation, usually income is shared or distributed through dividends. Okay, so we're done with assets. We're also done with liabilities and equity. Now, the assets, liabilities, and equity accounts are falling under the statement of financial position or our balance sheet. Okay, and these are actually called permanent or real accounts. Permanent or real accounts because these are actually the true balances at the end of the accounting period. Let's say, how much is your cash? Then you will be able to know how much is your cash at the end of December 31, 2020, for example. Okay? So, that is our permanent accounts. Those three are our permanent accounts. Now, let's go to our temporary accounts or nominal accounts. What are our temporary nominal accounts? Our number 4 major account is income, and the fifth major account is expense. So this income and expense are falling under the statement of financial performance. Again, statement of financial performance, meaning to say, statement of financial performance have only temporary accounts, while for statement of financial position, these have permanent accounts. At the end of the accounting period, we'll only be seeing assets, liabilities, and equity because our income and expense temporary accounts are close to our equity accounts at the end of the accounting period. To further discuss, our fourth major account is income. Income as defined is the increase in economic benefit during the account period in the form of an inflow or increase of asset or decrease of liability that results in increase in equity other than contribution from equity participants. Income encompasses both revenue and gain. What is a revenue? A revenue arises in the ordinary course of business. Its essence is the regularity. Revenue, when we are in the business or in the operations of business, like we sell goods in our business, then those amount of money accumulated in the sale of our goods are called revenue. On the other hand, gain represents the items that meet the definition of income but does not arise from the ordinary course of business. Say, for example, going back to our example, we are selling goods. Let's have an example, SM Supermarket or Lee Super Plaza. SM Supermarket, in the ordinary course of business, they are selling goods, whether it be RTW, whether it be basic commodities, whether it be appliances, right? So these are actually being offered for sale in our department store, in our groceries. However, gains represent those income that does not arise from ordinary course of business. For example, if Lee Plaza is selling its computer from the HR department because they believe that they will have to replace it with a new one, and then the old one will be sold at a cheaper price. So that amount of money, has gained a certain sum of money, then that would not be falling under revenue, but instead it will be falling under gain because it does not arise from the ordinary course of the business. What are examples of income? Number 1, sales revenue. Sales revenue, these are earnings made by the business engaged in selling goods to customers. When we receive revenues in the form of, or when we sell goods, we will be able to generate sales revenue. But when we engage in rendering services such as food industry, car washing, lawyer, or in the practice of profession, because we are rendering services, that we call it as service revenues. Now we also have professional fees. These are earnings made by professionals engaged in rendering the expertise. So like CPAs or like engineers or like lawyers. So these are actually termed as professional fees. Interest income, this income is earned through deposits in banks and other financial institutions. Income is a term used because it does not arise from the ordinary course of business. On the other hand, revenue is used if it arises from the ordinary course of business. Income, say for example, you deposited your income in the business in your bank account, in your savings account. After 1 year, it has yield an interest income, let's say 100 pesos. That 100 pesos, it is actually considered as gain because it does not arise in the ordinary course of business, or it does not form part in the operations of selling. Interest income. This income is earned through deposits in banks and other financial institutions. Income is the term used because it does not arise from the ordinary course of business. On the other hand, revenue is used if it arises from ordinary course of business. So interest income, meaning to say you deposit a certain sum of money from your business operations, and then at the end of the term, you will able to generate an income of, let's say, 100 pesos in your bank account. That 100 pesos does not relate to your daily operations in the performance of your business, because this gain or this income is attributed to depositing your account or your money to that certain account in a bank, wherein a certain time of period your money grows. Okay? So because you deposited that amount of money and the bank agrees that it will give you income in the form of interest. That's why your bank account was increased by 100 pesos through the income being given by the bank. But that 100 pesos does not come from your business, which is your normal operations. Okay? Now let's go to expenses. What are expenses? Expense as defined is the decrease in economic benefit. Decrease. Your income is increase, your expense is decrease. During the accounting period in the form of an outflow or decrease of asset or increase of liability that results in decrease in equity other than distribution to equity participants. Number one, your cost of sales or your cost of goods sold. This refers to the cost of the portion of merchandise being sold. These are directly deducted from the gross sales revenue in order to arrive at the gross profit. Now, your cost of sales or your cost of goods sold, this is actually the portion of the amount of the selling price which was used to acquire or which was used to make your product or your service. Example, you sell banana Q and you sell it at 10 pesos each. And then you believe that out of the 10 pesos, your cost of sales or cost of goods sold is at 4 pesos. So your gross profit would then be 6 pesos. Now, what is cost of sales? Usually in Tagalog or Bisaya, this is what we call puhunan. Okay? So you sell banana cube for 10 pesos, yung puhunan or your puhunan is 4 pesos. So your gross profit would be 6 pesos. Okay, that is an example of our number one expense, which is cost of sales. Number two, depreciation expense. This is already discussed a while ago. This refers to the portion of the cost of property, plant, and equipment charged to expense in the current accounting period. So for land and building, you could remember that we have depreciated the 1 million building 30 years. That's why every year the depreciation expense is 33,000 pesos when rounded off. Okay? Doubtful account expense. If you could also remember our allowance for doubtful accounts, this refers to the portion of the amount of accounts receivable estimated to be uncollectible and recognized as expense. If you could remember, in our previous example for allowance for doubtful accounts, 100,000 pesos because of bankruptcy, say for instance, you were able to provide, let's say 30% of 100,000 cannot be paid. So that is allowance of doubtful accounts. Now, at the end of the contract, the customer paid you, let's say, 80,000 pesos. 80,000 pesos is 80%, while 20,000 pesos was not being paid by the customer due to the present condition, let's say bankruptcy or the pandemic. So that 20,000 pesos is immediately considered as doubtful accounts expense. Why? Because this is recognized as expense in the current accounting period because this certain sum of money has not been paid already. Your allowance for doubtful account is just a provision of your estimate as to the uncollectibility of your accounts receivable. However, for doubtful expense or doubtful accounts expense, this is already the portion of the amount of your AR or accounts receivable estimated to be uncollectible and recognized as expense. Okay? Let's go to the next example of expense. You have salaries expense. So this expense refers to the services rendered by permanent employees in a company paid on a regular basis, either weekly, semi-monthly, or monthly payout. Next, we have supplies expense. Supplies expense refers to the amount of supplies used during the accounting period. Now, if you could remember 10 reams of bond paper, our example previously, our supplies expense is 6 reams of bond paper. Our unused supplies, which are our assets, remain to be at 4 reams because those 4 reams have been unused, while those 6 reams of bond paper have been used. That's why it's referred to as supplies expense. Taxes and licenses expense, this refers to our payment of taxes and other expenses related to licenses. Utilities refer to electricity, water, telephones, internet, okay? And usually paid on a monthly basis. Wages expense as contrasted to salary expense paid to regular employees, wages expense to temporary employees in a company paid on an hourly basis. So these are then our normal balances. By looking at the normal balances, our asset has a normal balance of debit. Okay? It is increased through debit as well. It is decreased through credit as well. Okay? So you will not be able to, or you may not be able to understand this clearly in this module. We'll further discuss this on the next module. However, to give you an overview of the normal balances of the different major accounts. Now again, the normal balance of our asset is debit. While for our liability and equity, our normal balances are credit. Okay? For both liabilities and equity. For your revenues, our normal balance is credit. For expenses, it's debit. Contra asset account, because it is contra asset, we need to say against the definition of asset. So therefore, if the asset's normal balance is debit, our contra asset account balance are credit as well for allowance for doubtful accounts and accumulated depreciation. Same applies to our equity. Our capital normal balance for equity is credit. When we withdraw cash from our business, it is considered, or it is usually in the normal balance of debit. Okay? Our accounts are increased through the normal balances. As you can see, asset normal balance debit, so it can be increased through debit. On the other hand, if it decreased, then it should be credited. Same applies with your revenues and expenses, wherein your revenues normal balance is credit, then it could also be increased through a credit. Say for example, if you have additional sales, then you credit your sales. Then if you have sales returns and allowances and sales discounts perhaps, then it is debited. Okay? So we will further discuss this one on the next module. Are we okay with the 5 major accounts and its normal balances? Before we proceed to our next topic, which is our competency number 2. So let's proceed. Chart of accounts. A chart of accounts provides a listing of all entities' general ledger accounts in a systematic form. It guides the accountants in ensuring uniformity of all the accounts in the business. Usually, it consists of the 5 major accounts arranged accordingly. Each account is numbered for easy tracking. The chart of accounts does not follow a fixed format or standards. Account names are identified and arranged at the discretion of the management, and usually, management places a gap between each major account to allow additional specific accounts that may arise in the future. Let's take one P. Rodriguez chart of accounts as an example. So we have here the chart of accounts of one P. Rodriguez computer shop, wherein his assets were labeled, or the asset account starts with 1. As you can see here, usually our assets start with 1. And then liability starts with 2. Owner's equity starts with 3. Revenue starts with 4. And expenses starts with 5. So we could easily identify that this is actually an asset. Or perhaps, since it's number 4, the start number is number 4, then this is actually a revenue. So we could easily trace our accounts. Now again, this is management based or depending on the discretion of the management. The standards does not dictate that the asset should be 1. The owner's equity should be 3. It depends on you. If you want 3, then you can put 3 here, 301 for your assets. If you want expenses to be 7, then you could put 701, 702, 703. It actually depends on you as the business owner or the manager of the business. Now this one will be further again discussed in the next modules. I believe it's gonna be in module 6, wherein we will start our journalizing and posting of our transactions, because these are very important. Now, as seen on our screen, These are our five major accounts, and the numbers representing our different accounts, 101 down to 599. These are actually our account codes or account numbers. And our accounts are actually the sub-accounts of our major accounts. So we have cash, land, revenue, income, and then expenses, capital, or payables. Okay? So I believe you were able to get a better grasp of what are the five major accounts of accounting. Next week, we will discuss the accounting equation. I hope you learned something today and see you in our next